Hi everyone, thanks for joining our webinar today. Krypt is co-presenting this webinar with SAP. We are presenting on duty drawback in hopes to help you prepare for the upcoming regulation changes. Our presenters today are Linda McKee. She's a Solutions Management Director for Global Trade Services at SAP, and Aaron Scholl from Krypt. Aaron is a Senior GTS Consultant and Licensed Custom Broker. On the next page, I will quickly go over some housekeeping tips. During this webinar, everyone will be muted, but if you have questions, please feel free to type them into the questions box. We've tried to save a portion of this webinar time for Q&A. We do have a lot of content to run through, but feel free to type your questions in. If we don't have time at the end, we'll be sure to follow up with each and every one of you. And we'll also have our contact information at the end, which you can feel free to reach out to any of us. Quickly, I'd like to go through the agenda on the next page. For this webinar today, we will quickly go through a quick Krypt introduction, just an overview of who we are. Then we will go through an SAP GTS overview or review to at least level set. Then we'll discuss what duty drawback is. We'll dive into the new drawback regulations. We'll get an understanding of using GTS with drawback, and we'll give you some information about what you can do as next steps. And then, as I mentioned, we'll end the webinar with a Q&A section. I'd like to just quickly introduce Krypt. I won't spend too much time on this, but just so you guys know, on the next slide, we have some information about us. We are a global SAP partner. We are a consulting firm, and we have offices spanning the globe. Our headquarters is in North America. We have offices in Europe and Asia Pacific. We have a strong focus on the SAP GTS side, as well as other modules, including GRC and other supply chain modules like TM, EWM, HANA. And we do pride ourselves on thought leadership and providing resources to the SAP ecosystem. And on the next slide, you'll just see a couple of the books that we've authored. We do have white papers and other resources available for educational purposes on our website. So feel free to check those out in your free time. And on the next page is just a quick overview of some of our customers across various industries and located globally. At this point, I'd like to hand it off to Linda McKee from SAP.
Thanks very much, Kylene. And go ahead and go to the next page. And it's always a challenge with some of these webinars, is not everyone is familiar with GTS, or Global Trade Services Solution, or even SAP. So just to sort of level set, our Global Trade Services Solution does sit in our suite area of governance, risk, and compliance areas. So within the international, and we'll refer to it as the International Trade Management area. So there we have GTS, and then we also have some other newer functionality. You may start hearing about our SAP S/4HANA International Trade. So that's essentially similar to the old foreign trade functionality we had in ERP, our new watch list screening solution. But today we really want to focus on our core solution, our Global Trade Services Solution, and how that can help to enable you with your duty drawback activities. We can go to the next one. So we really found that within organizations, we're starting to see the global trade team, or in some cases the international trade team, it's always a matter of semantics, be elevated within the organization. But from a GTS perspective, we also try to focus on both sides, whether you're more focused on your exporting activities or your importing activities, or both. We really do provide full coverage for all those processes. So you can really focus on automating a lot of those import and export processes, as well as your screening of third parties relative to compliance, and really automate that to enable your efficiency. Increasing interest in free trade agreements, obviously something we hear in the news a lot here in the US, whether it's discussion of ending TPP or renegotiating or changes to NAFTA. Free trade agreements are another area that get a lot of visibility, and an area we also support within GTS. The special customs procedures get increasing attention, I think, as we've moved into this ACE environment, where more and more companies are looking at doing their own e-filing of their entries and the processes related to their imports and exports, or finding ways to improve that process with their brokers that may handle those processes for them. Other areas around bonded warehousing and China-specific capabilities. And then one of the key areas that we've seen with GTS is really leveraging a single instance of a international trade platform, where you may have multiple back-end systems. Every country, every region may have their own landscape that you still want to centralize and automate some of your global trade processes. And we really see value in organizations leveraging GTS as that single international trade platform for all of their global business. You can go ahead and go to the next one. Just want to highlight GTS. Gosh, I was just thinking about that prior to the conversation. I think GTS is a standalone solution. We're about in our 20th year now. So we've continued to grow and invest in the solution. It is our flagship global trade solution going forward, and we continue to be highly rated with the analysts in terms of being, last year we were again rated as the #1 global trade solution by ARC. We have over 2,300 customers around the world using the solution in 170 countries and across a wide range of industries. Virtually every industry that SAP supports, we can provide support within GTS. We can go ahead and go to the next one. So I already touched on this, but just for those that maybe are not as familiar with GTS, it does have quite a bit of breadth of functionality as well as depth. So the restricted party screening was one of the earliest and tends to be one of the most implemented areas within the solution. So if you're trying to manage and screen all of your business partners as it's related to denied party lists and other lists issued by the governments, but GTS has that ability to support you with that restricted party screening and do it in a real-time or batch mode, whatever works best for your business, and whether you want to actually screen your transactions, be it your sales activities or your purchasing activities, HR, financial, all of that is possible with GTS. With export and essentially the flip side of that, import, but managing all of those processes, whether it's classifying the materials to assure you're compliant with rules and also getting maybe the best duty rates associated with your goods, managing any licensing that's required, managing the license themselves from setting those up in your system to automatically determining which licenses are appropriate or needed for which transactions, managing some letter of credit activities on your exports. And also a key area that we're seeing increasing interest is that direct filing process. So we are certified with certified interfaces in a number of countries, largely, we'll admit, in Europe and US, but we do have that certification also with China, though that does tend to be more of a manual interface, but we do have a process for China to allow that direct filing. But seeing increasing interest there. I'd already touched on the trade preference area, where supporting free trade agreements and using that around the globe, whether that's requesting the certifications from your vendors relative to the goods you procure, to determining which of your goods qualify for those free trade agreements, and then also allowing your customers to benefit from those qualifying goods by issuing certificates to them as well. And then that special customs procedure area, from foreign trade zones in the US, processing trade in China, Also some real strict requirements there in terms of e-handbooks, and very similar to foreign trade zone requirements in terms of inventory management. Bonded warehousing, inward and outward processing, more focused on Europe, as is the intrastat and the excise movement, or the EMCS processes in Europe. So GTS provides a full scope of capabilities to support your business around the world. Even in those countries where we may not provide that localized certified interface to customs, customers are still utilizing the solution, either using their brokers for that final leg of filing with the government, or you can also arrange that communication yourself because of the technologies layers associated with GTS. Go ahead and go to the next one. So when we start looking at duty drawback, again, GTS is going to contain the vast majority of the data that you're really going to need to support that filing process, in terms of you can manage your exports and your imports within GTS. So I touched on the classification. Obviously, it needs to be accurate and consistent. Having a global trade solution such as GTS enables that, allows for central classification teams. We see that very commonly within GTS, and then still allowing regional groups to maybe add the last 8 or the 10, go to the 10 digits to make it more specific to their requirements in country. Again, you can handle all the aspects of your export and import processes, from those license managements to actually doing the duty calculations and filings, as well as the documentation associated with your exports and imports. All of this is managed in databases so that you have full access to all of the data required to really do the appropriate drawback analysis and your final claim submission. As I also mentioned, it is a global platform. So in addition to providing a number of out-of-the-box type of processes, it also provides a framework to support processes such as duty drawback, where we see every company tends to want to manage some of those processes a bit uniquely. And so we really want folks to be able to leverage the framework within GTS, all of that information that you provide and have access to with your export and import processes, and really understand how to leverage that for additional processes such as duty drawback, and leverage a partner such as Krypt to enable that for your company. So when we look at some of the overall benefits of having a GTS system, obviously having that one platform or that one instance really allows you to be consistent with your global trade activities across your business. It still provides that flexibility to support in-country or in-region requirements, but you have a single view of all of those global trade activities. There's a tremendous amount of data accuracy with full history, also a key component of programs such as duty drawback. Obviously, you need to be able to retain those records, have access to those records, and be able to demonstrate due diligence in your processes. And with a solution like our GTS solution, all of that is enabled within the solution itself. And again, you can enable your duty drawback claims and refunds, the focus of today's discussion. So even though you may not go into a menu within GTS and see something called duty drawback, you can absolutely leverage the solution and all of that data related to your imports and exports within GTS to support a strong and robust duty drawback process. So with that, I will hand it off to Aaron, and he'll give you more of the meat of the webinar. Go ahead, Aaron.
Well, thank you very much, Linda. That was a great introduction. I'm going to touch back on a lot of those points in terms of having an integrated system and sort of a framework for collecting drawback information and be able to manage that. Just a quick introduction for myself. My name is Aaron Scholl, and I head up the Krypt's business consulting team. So I've been on a lot of engagements in consulting on business issues, and drawback has come up a lot at our different clients. So it's an issue that I think is always sort of in the back of people's minds, especially if they have big imports and exports. And with these new rules, which we're going to talk about sort of on a high level, we want to just sort of make this sort of an overview introduction and maybe a catalyst for some further thoughts when you look at your business. So this session, I'm assuming a lot of the people who are dialing in are either already have some sort of a drawback program. I'm assuming it's maybe some people maybe don't have a drawback but are interested in finding out a little bit more about it. So I want to keep it fairly broad, and to that note, I want to sort of introduce the subject and sort of level set and get us all thinking about, exactly what is drawback, to understand how it would affect your unique business circumstances. So basically, the drawback is a refund that you can claim on imported merchandise. So this is merchandise that's either exported unused or in the same condition, or it can be a refund on imported merchandise that's used in some sort of a production process. The information out there about drawback is that only about 20% of exports that theoretically could be eligible for drawback are claimed. So that equates to approximately $2.5 billion that exporters, importers, and manufacturers theoretically could claim from the government, but don't. So it's basically effectively lost revenue for these companies. And the reasons why this money is unclaimed are that drawback rules are very complex. There are also largely a lack of awareness of drawback. A lot of big corporations, operate many different legal entities and under silos, and maybe one part of the company doesn't know what the other part of the company is doing. And again, that leads to sort of lack of data and information to make informed decisions on where some of the opportunities are. So I want to, later on in the presentation, touch on some of the ways that these barriers to claiming these refunds potentially can be addressed. So as I said earlier, there's two main types of drawback. There's probably the biggest volume would be manufacturing drawback. That is where imported goods, so goods that are imported into the U.S. are used in a manufacturing process in the U.S. So that would basically take those imported materials, use it in manufacturing, and create sort of a U.S. good that is exported. Depending on the business and the importing and exporting scenario, there may be general rulings that are out there that you can follow, or if there isn't a general ruling, you think you have an opportunity, you can talk to customs and get a specific manufacturing ruling. So again, this is part of the complexity. It depends on the business that you're in, materials that you import, how you manufacture. So there's so many variables. It's hard to look at a one-size-fits-all approach. But in general, this is one of the most important types of drawback, is the manufacturing drawback. There's also rejected and unused drawback. So that's imports that are rejected by the importer, or unused, where you can use direct identification and substitution drawback. Where it gets interesting is to substitution, and where the new rules are sort of opening up additional possibilities for importers to potentially claim more drawback benefits on unused merchandise, and we'll get into that a little bit later. So who qualifies to claim drawback? Again, drawback is the opportunity to claim a refund on an importation. So there's really many different scenarios. Probably the simplest scenario would be your company is an importer. It imports materials. It uses those materials in a manufacturing process, and then it exports them. That's probably the simplest and most understandable scenario. That's where you would have all the information basically in your systems to track the importation, manufacture, and export of the material. Other scenarios could be you could also be a manufacturer and purchase from a sort of a third-party importer goods, manufacture those, and use those in your manufacturing process and export those. That's also a scenario where the exporter or manufacturer could potentially claim some drawback benefits. Probably the third main scenario is an exporter who purchases a product made from imported merchandise. And in general, it's the exporter who is sort of the first available to claim these drawback benefits. So these drawback benefits can be assigned. So different parties in this string can assign the drawback benefits to another party. And so that's sort of a key element in making why this is so complex and why some companies don't take advantage of it. Maybe some companies aren't aware that these rights are assignable, or they have difficulty in getting the sort of the supporting documentation to support a drawback claim. But a key thing to remember when you're looking at your own business process is that there's a possibility of assignment of drawback rights to different parties in the transactions. So that's why it's very important to understand your business process and look at some of the opportunities that might be there for you. So what's involved in being able to claim? So sort of the key things that you need to have in place are a drawback program with procedures that everyone in your company that's involved in these transactions can follow. If necessary, getting customs approvals on your manufacturing and substitution processes, and also maintaining the relevant documentation and data. And this, again, is an area where, as Linda was saying, a centralized, automated integration between your import-export system and your ERP can be very, very important. Also, obviously, from a compliance standpoint, having internal controls in place, being able to reconcile the information and data, and have all the necessary documentation to support a claim. So if you have a claim and the rights have been transferred, some of this supporting data for your claim you might have to receive from either your vendor or your customer, depending on the scenario. And then the last sort of key thing to be able to file a claim is actually processing the claims with customs, either directly or using the services of a broker or drawback service provider. So it's sort of just a level set on what drawback is, and then sort of at a high level, what are some of the scenarios. So now I wanted to touch on some of the new regulations that are coming in place, and just sort of give you a general overview on some of the impacts and some of the things to think about when you're looking at how these new regulations may affect either your existing drawback program, or they might spark you to think of ways that maybe drawback could be incorporated into your business if you're not currently taking advantage of it. So the key legislation that is coming into place is the Trade Facilitation and Trade Enforcement Act. This is part of a larger World Trade Organization framework to facilitate and simplify global trade. The facilitation part of it essentially makes drawback easier to file. As part of this act, the drawback is actually a small portion of this act. It also addresses enforcement issues, anti-dumping, countervailing duty, establishing centers of excellence within customs, increases the de minimis requirement for import reporting, and it has provisions about forced labor and intellectual property. So actually drawback the drawback simplification is just basically a small part of this act. Another key part of the act is increased funding and development for the single window ACE, and so that also has an effect on how drawback claims can be filed in the future, and we'll touch on that. So the go live date for these new rules is next month. As of next month, electronic drawback, if you're filing electronically in ACS, those claims must be done in ACE. Between February this year and February next year, you have the opportunity to decide how you would file, either under the existing rules but using ACE, or under the new rules. So basically, and we'll talk about later, you should really take a look and see how these, if you are filing drawback, how are these new rules going to affect your drawback claims. So again, I talked about the 1-year transition period. You have the ability, if you are currently filing, you can use the new rules or the new rules. After 2019, February 2019, all the claims must be filed using the rules in the new rules. They will accept manual claims, which can be filed using filing at the drawback centers until February of 2019. After that date, Customs has said that every claim will need to be filed in ACE using the new rules. So again, if you have maybe a small volume of drawback claims and you file those manually, within a year, you're going to have to look at a way to file those electronically. So that might be an impact on some of you who are filing manual claims. So I wanted to talk about what are some of the key changes, the key things to think about when you are looking at the new rules. And I've sort of ordered these in order of impact and importance. The first rule is that Customs is moving from sort of a commercial interchangeability standard to an 8-digit substitution standard. So what that means is for substitution drawback, you can use the rule of using 8 digits instead of qualifying for the same kind and quality standards before, which were very complicated and complex and required you to get a lot of rulings and very subjective. Now it's a more sort of objective standard of using 8 digits of the tariff schedule to identify substitution drawback. So to talk just a little bit about the tariff schedule and what that means. Every article that's imported, you have to, when you file your import entry, you need to, in the U.S., file a 10-digit classification that tells Customs basically what that material is. And at a high level, at least at a 6-digit level, all these classifications for materials are basically global classifications. So the first 2 digits are the chapter, the second 2 digits, the fourth digits basically are the grouping within that chapter. The 6-digit level are more specific breakout of that product. And worldwide, ideally, every product that's classified should have the same 6-digit level. When you get to the next 2 digits, which is the 8th digit, in the U.S., that's the level essentially at which the duty rate for that import is set. And then the following 2 digits, the 10 digits, those are used for statistical reporting. So the old requirements basically required you to match on a 10-digit level when you're using the substitution. Now, that's sort of relaxed and allows you to use substitution drawback at an 8-digit level. So, depending on your business and how your products are classified, this could have a very big impact and open up a lot more opportunities for substitution drawback, or it might have a more limited impact. That's because you know, the 8-digit levels are set sort of sometimes arbitrarily, you know, by and sometimes they don't make a lot of sense how things are broken out, because they're set by to collect revenue and trade protection, and different factors involve how the 8 digits are set. But potentially, depending on how your products are classified, this could create a lot of additional opportunities. So a couple of caveats with this relaxation of the substitution standard is, if your import classification begins with other at the 10-digit level, then you need to match that with other when you are exporting. And also, substitution is eliminated for exports to NAFTA and Chile Free Trade Agreement countries. So again, understand, if you are taking advantage of NAFTA or the Chile Free Trade, there may be some limitations on that. But essentially what this means is that more products may be available for substitution drawback. And again, if you're not claiming drawback and you think there may be a possibility, it's definitely worth taking a look at your end-to-end process to see if there are some opportunities for substitution. Another impact, again, if you do have an existing drawback program and you have drawback reporting, you need the flexibility to be able to use this 8-digit level if you're currently using a 10-digit level. Another impact to being able to file drawback is it's increasing the time that you can claim a drawback. In other words, the time between the import and the export is basically standardized at 5 years. Some of the earlier processes already had a 5-year, but under others it was a 3-year window. This basically simplifies, no matter what type of drawback you're using, it simplifies it to a standard 5-year, basically a 5-year claim from the date of import till when you can claim that export. So what this means is, when these laws are in effect next month, you effectively can go back probably an additional year or so, back to 2013, imports in 2013. So again, if you are a drawback claimant now and you are seeing those 2013 imports expiring, if you file under the new rules, you can potentially go back at least another year or so and have additional imports to claim. Another important change that we touched on a little bit earlier is that all drawback claims eventually will need to be filed electronically. So if you're currently filing an AES, you need to file an ACE, basically. And if you're manually filing, you need to file electronically in the future. What this means, especially if you're manually filing, an electronic filing really will speed up the refund process. So manual claims, Customs says they'll be processed within 90 days, but ABI claims will have priority. So basically what that means is you'll get your drawback refund a lot faster if you file electronically. So again, if you're claiming a substantial number of drawback, if you have a big volume of drawback refunds, this timing really can increase your return on your drawback process in terms of getting your money a lot quicker and improving the time value getting those drawback refunds. Another key change is the valuation of what you can claim for drawback. The new regulations add some additional taxes and fees that you can claim. So before that, it was essentially 99% of the duties. Now it's increased to some of the taxes and fees as well. So again, this increases sort of the base that you can claim for your drawback. Another thing to think about is for substitution. Any claim that you make is calculated at a lesser than basis, which means you have to look at the valuation of the export versus the import and claim the lesser value. So for manufacturing, for example, the refund, a drawback refund will be the lesser of the duties paid on the imported merchandise or the valuation of the substituted merchandise had it been imported. So this requires some additional sort of evaluation of your process and your valuation when you value exports. And again, is another strong reason why tight integration with your ERP and the values there can be very important to look at this. Another thing to think about is that because of the 8-digit substitution, you may have some very different kinds of materials that fall under the same 8-digit level. So if you have a very expensive imported item and also under the same 8-digit, a very inexpensive import item, and those are exported, you really need to be able to track back and claim the higher value against the export against the higher value import, and the lower value export against the lower value input. If you don't have a system to kind of monitor that, you may inadvertently claim a higher value export against a lower value import, and that would basically reduce your drawback benefit for that. Some of the other changes are along the documentation that's needed for a drawback claim. It basically simplifies the records that you need to keep. Prior to the new regulations, transfers needed to be supported by a customs form, a certificate of delivery, certificate of manufacture, just customs forms, and then supporting records for that. Now, those customs forms are no longer needed, but we do need to have the business records that you normally would keep to support those transactions. Also, evidence of export, you don't need to necessarily get the carrier bill rating. You may, if you have access to it, use the export record. Another additional sort of requirement is under the old regulations, you didn't necessarily need support under manufacturing with your bill of materials, but now a bill of materials is required if you're using the substitution manufacturing. So again, this shows how important it is to be able to integrate with your production systems and your ERPs and have access to that bill of materials when manufacturing. So some of the other impacts that are maybe not quite as big, but definitely are worth mentioning are they've increased the joint and several liability for a drawback claim. Before, it was basically limited to the claimant. Now, basically, other parties to the transactions may be liable in case there's some sort of a misfiling or mistake in the drawback filing. Potentially more parties to that transaction could be liable for drawback claims. Record keeping requirements have actually been increased. Before it was 3 years from the date of liquidation, or I'm sorry, before it was 3 years from the date of the payment of the claim. Now it's 3 years from the date of the liquidation. So basically this ensures that everyone who's claiming drawback has the supporting documentation through the period when that drawback claim is liquidated by customs. And another thing just to keep, this might be a corner case, just a very small impact, but U.S. goods returns now potentially may include some non-U.S. products. So basically what this means is if you do have entries under 9801, which are goods returned, you need to really understand, have you claimed drawback benefits on those same goods, and basically have a process in place to control these goods returns. So if you do have an existing drawback program, that's probably already part of what you do, but this sort of expanded scope of the 9801 to include non-U.S. product, we need to think about how that impacts your existing program. So at a high level, that's basically the key impacts of these new regulations. Now, what I wanted to talk about basically for the remaining time is how can GTS, which is an automated import and export system, help you kind of manage some of these risks, identify some of the opportunities. How can this integration work between your ERP and manufacturing and your import and export filing? How does that look? So, so these are some of the pain points that probably every drawback filer has. Having lack of integration, no centralized repository of drawback information, no real easy or efficient way for the business user to look across the company, across legal entities, and identify drawback opportunities. And also, it could be if you're using several customs brokers, monitoring the claims filed is probably a sort of a manual process involving probably a lot of spreadsheets and manual work to be able to monitor those. So what I've done here is just at a very, very high level, this is sort of a diagram of how a GTS or centralized import-export system can be used to address some of those pain points. So starting from the left here, this is sort of going through time. GTS, based on purchase orders in your source system, can file import entries. So this takes your material and adds a classification to it and files that import entry either through your broker or directly with U.S. Customs. And that data is stored in SAP GTS. That material is used in a production process. So if there's a production or process order on that imported material, there's production data in your ERP. There's inventory data, the movements of that material in and out. There's also, if you're integrated with SAP with transportation management, it shows information in terms of additional information on those goods movements outside of your inventory. So there's an ability to use some of this information in terms of, if you use BI reporting, you can use info cubes for ECC and GTS to basically extract this key data and use that in drawback reporting. It's a very flexible tool to enable you to basically cross systems, sort of combine that data and use that for monitoring and to identify drawback claims. If there's a drawback claim identified, potentially that can be filed using GTS and filed with customs, or again, your broker, and that data can come back. So basically there is a way to have an end-to-end repository of all the information that you would need to sort of monitor and control the drawback activity. And to that end, once the data is there, it's in the system. So GTS can be used to identify opportunities, monitor claims, use BI reporting. It's also a possibility to use standard reports that can be designed specifically for a process to, again, basically give you that same result of identifying drawback opportunities. And again, with some specific configuration, drawback claims can be processed using GTS and either filed with the broker using the broker model or directly with customs. Here's an example of some drawback reporting uses using BI and using that report tool both for manufacturing and direct identification claims. Also integrating the bill of materials and production information to basically monitor your drawback activity. So here's sort of a scenario for a production manufacturing substitution. So this would be how a report would work using this integrated process. So the user would enter the sales for export. So drawback can really only be claimed on something that's exported. That would take that material, explode the bill of materials to identify those components. And then those components would be related to purchases or import entries. And then those import entries could be sort of grouped by HTS at the 8-digit level, and all related materials using the 8-digit HTS could be queried, and then that would show you sort of your purchases, either both domestic or import. There could be potential candidates, and from that point, you could ideally match these purchases with GTS declarations, because again, it's an integrated system, and identify duty paid on those imports. And for third-party purchases, there is a simulation about the duty paid amount to see if there are drawback benefits on third-party purchases. If you have integrated system reporting like that, there are other advantages. You can do landed cost analysis, profitability analysis, and we've done projects where it's taken very granular data in terms of time, date stamps of order processing to monitor KPIs for inbound and outbound, and also leveraging external data inputs in the reporting. So again, the ways GTS can add value are an enabler for your compliance program in terms of record keeping and monitoring, utilizing e-filing for accelerated payment. And that's another benefit about having an integrated program that customs would give you benefits for accelerated payment and drawback, and also looking at your end-to-end process to identify drawback opportunities. So looking at this and some of the advantages that are out there, what are some of the things you can do to really understand how these new regulations can impact your business? So, first of all, I think the first thing to do is look at your total duty spend. So if you're importing materials that are duty-free, basically there are not drawback or opportunities there. It's really where the imported materials or the materials you procure domestically that are imported, if those are materials that have a significant amount of duty, then theoretically you would, and those you have exports, theoretically that's where your opportunity may be. If you're a large exporter, you need to understand your end-to-end supply chain, and including the origin classification of goods that are exported. So these are some of the key things. Look at the impact of the changes, review your process, and leverage your system. So what does that mean? If you're currently import, look at how the 8-digit rule will affect you. So sources of information, if you do use GTS, broker records or some government reportings that can help you understand how that might affect you. If you are currently using substitution, do the new rules expand your pool of exports, your pool of imports? If you're claiming a substitution for manufacturing, again, are there more imports that you can claim? And then also look out the new value rules and how you might need to manage the valuation imports versus exports. Also, just look at your business. If you have a large number of different corporate entities, you may not have visibility to some of these. If your company, if it's sort of siloed, there may be big opportunities in really understanding the end-to-end process across all the legal entities to really understand what is the potential pool of drawback opportunities that you might have. If you're an importer and you sell domestically to someone that may export, you might be able to claim, share the drawback benefits with your customers. And again, look at the benefits of quicker cash flow for filing electronically. Another thing is, make sure your classifications are accurate. A lot of companies, sometimes a default is to other when maybe a more specific classification might be available. And again, especially if it's a huge volume and opportunity, just really makes sense to look and see for those materials that you identify as drawback opportunities that the classification is accurate. Also, just look at your import entries and see how they can be used to facilitate the drawback claims. If you're using a broker, the GTS is a broker enablement model to basically interface data between the GTS system and your customs broker to increase the visibility and reporting that you have, and especially if you use several brokers, it can centralize a lot of that data and make that available for business decisions. And as Linda said, some of the key takeaways are that there's really no out-of-the-box solution, no one-size-fits-all for every importer. As we can see, some of the complexity involved. Any solution really needs to be tailored to your specific business requirements. But the data is in there, both in your source system, if you use ECC as your ERP, or other system, and GTS, the data is there available to you either through your source system, a combination of your brokers and government reports. Another key takeaway is if you do think there are opportunities available to you, you can leverage the support of a service provider. The service provider can help you understand and design requirements and work with the users. Very knowledgeable on best practices and configuration options in GTS to streamline any solution. And have, like for example, Krypt, we have a lot of pre-designed templates and accelerators that make this build and design process a lot quicker. And also make available, technical experts that can leverage your existing resources. So I guess the key takeaway from this information is, look at your business, understand how the new rules affect your business. A lot of times we're in the compliance mode, and this is an opportunity here to kind of partner with different areas of the business, identify opportunities, and really show the value of the import-export compliance and logistics functions. This end-to-end analysis can potentially help discover new and expanded drawback savings opportunities, and also just sit back and look at the information that you have to see, is there a way to take all that important and valuable data that you have there and string it together in a way that it can be used to kind of leverage savings using drawback. So that's what I had today. I think we have a few minutes. If there are any questions, Linda and I would be happy to address any of those.
Thank you, Erin, for the presentation. Yeah, as Erin mentioned, we have just a few minutes for questions. On the screen is our contact information, so feel free to reach out to us individually. We encourage questions. We're happy to set up one-on-one calls or just exchange emails, whatever is easiest. But we hope that this webinar was educational for everyone. And I will dive into a few questions now. We're almost at the hour. So any questions we don't get to, we'll be sure to follow up with you individually offline. So one of the questions that we've gotten a few times is just if this presentation will be available, the recording as well as the slides, and they will. So everyone who attended and registered will be sure to send those out. You should get those in your inbox probably in the next 24 hours, but hopefully by the end of the day. Another question we have here is, does GTS have a specific module that covers duty drawback?
Yeah, Kylene, this is Linda. I'll go ahead and take that. And no, if you there is not an out-of-the-box part of GTS or somewhere in a user menu where you'll find duty drawback. At this point, that's not something that we've delivered out of the box. It really is intended as that framework where the information is there and it resides there, and then working either if you have, some strong skill sets in your own team or with someone, a service provider like a Krypt, who has a lot of experience in this space. They know how and where the data resides in GTS, can help you really leverage that data and really meet the specific requirements of your need. There have been times we've considered including duty drawback, but every time we've sat down and had conversations with customers, it was virtually impossible to come up with a standard set of criteria and processes that those customers all wanted to use. So at this point, the plan is really to continue to support the import-export processes, have that data available, and then leverage a partner like Krypt to help you enable that and really access that data through the reporting and the extracts of the data to identify those drawback information and opportunities.
Okay, thanks, Linda. We have another question here. Are duty drawback claim opportunities less for companies that have FTZs?
Yeah, I can sort of address that. Basically, the idea of an FTZ is that you would bring goods into the FTZ, and at that point is when you are deferring your payment of duty. So basically, in a standard FTZ concept, you aren't paying duty on goods that are in an FTZ. You bring those in basically duty-free and provide manufacturing and ideally export or import those into the commerce. So, you'd have to look at the specific examples of what, if you're paying duty on that imported merchandise after it's processed in the FTZ, and just basically look specifically at that business process and understand what are the requirements. But in terms of FTZ in the regulations, there aren't any specific, it doesn't specifically address that, but the regulations are still sort of I believe, a work in process. So I think it's valuable to look at any updates and changes to those regulations on how it would affect the FTZ process.
Okay, great. Let's get to one more question. I know we're at the hour, but this question is, what about anti-dumping goods? Can you claim duty drawback if the goods come in and then are used in manufacturing and then exported back out?
Anti-dumping countervailing duties, I believe, are specifically out of scope for duty drawback. I think that's a specific provision.
Okay, great. As I mentioned, we do have our contact information here. I encourage you to reach out with further questions. I do see that there are a few more questions here, but unfortunately, we do have to end the webinar at this time. I thank everyone for joining us, and Erin and Linda, thank you for presenting this information to us today.
Thanks so much.
Thank you.
Appreciate everyone's attendance. Thanks,
Okay.
Erin.
Have a great day, everyone. Bye-bye.